Ladies and gentlemen of the crypto space, we're live on a Monday, July 19th at 11:38 a.m. And today is the day that my words hopefully will resonate and make a difference, probably, hopefully more than ever for persons. This is a time where the bearish sentiment is pervasive in the market. People fear their dollar denomination of their positions being lost, and the often neglected is time horizon and the macro market conditions that I want to dig into a little bit or a lot of it. I want to start with two things, and I want to. It's two. One is a college story, and another is a comment just posted by Terry Kinder. Who it's a great statement, and I want to dig into a bit, particularly because it's relevant, maybe more so than ever on a day like today. Respect your expression of macro market conditions. And what are those macro market conditions? Have the macro market conditions changed? And they, little preliminary monologue, based on the work of Stephen Van Meter and others, they haven't changed. The macro market conditions have always been strongly deflationary. The system wants to implode. The debt is held up by frivolous inflationary forces, and that's the fight. The fight is the bubble contracting versus the countries that want to keep it inflated, and the war is between the system wanting to do what it naturally. It's not really a natural phenomenon, but what it inherently wants to do, versus the intentions of these central banks of sovereign countries doing what they think is the right thing to do. And in many regards, it is, because if the system does what it's naturally supposed to do, we're going to have a variety of humanitarian crises on our hands. Not that we don't have humanitarian crises with the system actually functioning as they want it to. How many people in poverty and die every day and starvation? Anyway, that's another story. But if the system contracts and does its deflationary implosion, that's going to pretty much um, be devastating for social stability. The retirement population will have a crisis. Pensions will collapse, and this is stuff that like Raul talked about, early last year. And all these ideologies resonate with me very meaningfully. And I just posted on Twitter that we're supposed to take these ideologies and digest them and understand them and form our own ideas and ultimately express them in the view of the markets. And that's what I do, and that's what I tell you guys, with regard to hedging the hedges of the hedges. It's not fear and doubt. It's understanding reality and the way these markets may or may not behave. No one knows. We only know in hindsight what the market's going to do, but we know the pressures and the tendencies and what the market wants to do. And we know that we have gross interventionism. We know that's there. We know what the bureaucrats want to do. We know what the system wants to do. So technically, we're waiting for the culmination of the war of powers, and who will prevail. Let's dig into some comments. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto. Non-custodial DeFi or nothing at all. Bam, let's pop it over to the main screen and see who's in the stream. Got Joe in the house watching you, and Taiki provide me with nostalgia of being back in law school, business school. Yeah, that's the way I view pretty much all value allocations, unless it's speculative, of which I have a variety of speculative allocations in the securities markets that have a 10-year time horizon. They're assets that I've had since like 2016, and I won't be looking at them until 2030 because that is the set in stone time horizon that I've defined. And there's nothing that's changed about the narrative that I have with regard to particular securities dealing with battery metal miners. And it'll take another 5, 10 years from now. 9 years till 2030. Another 5, 10 years, give or take. Igor's in the house. Zach, my man, ding ding. Captain Weber's in the house. How are you, my friend? Hope all is well. Mark, Outlook doesn't look great. Food may also be a good investment. Well, Michael Berry liked water back in 08, 09. And it turned out he was spot on, man, with all the alcoholic beverage producers doing seltzer products, literally water. Crazy. Awesome. What is VEFXS? Yield paid in VEFXS. Yield is paid in FXS. Think about DCAs and BTC or ETH, but what to do with the CVX CRV rewards this month? Well, I expressed to you ultimately what I do, and my the story I tell you is to be deflation protected, inflation protected, and you need liquid capital in order for overhead expenses. So you work on a daily basis for that gives you revenue, a revenue stream for overhead expenses, and you should be covering your bills using your salary. And you shouldn't be in debt. You shouldn't spend more than you make. You should live below your means, and that means you've accumulated and are accumulating liquid fiat capital. And now the burden that becomes, what do you do with it? You're accumulating capital week after week, month after month, year after year. And what do you do with it? Because storing it in dollars has all the considerations that we've talked about extensively. And then that brings us into markets, that brings us into various asset classes. And as of right now, folks really want to be deflation protective. And that's how do you do that? That's T-bills, bonds, and long dollar forex positions. I don't have any long dollar forex positions. I guess maybe I'm tempted to, but I don't need to. You know why? Because it's a speculative position, meaning you have a position and you have to sell it at an opportunistic time. And I'm not a fan of that, which is why the vast majority of my market behavior reduces to old school dividend investor mentality. And really, like what Joe says, business school, I like to think about these things as businesses. And that makes it much more easy for me to process and tell stories about and express to you guys how I view these markets. Now, back in college, I was in a philosophy class, and I was young, and folks thought I was crazy. And I once said the objective perspective, and that blew people's minds. And this was a freaking philosophy class, so that blew my mind. So I'm like, you guys don't understand that perspective, and I mean, technically, no human being can be objective, and this goes back to like Socrates and Plato and stuff like that. Um, it's impossible to divorce oneself from emotions. And as you can see on the screen here, Terry said, ignoring emotions is one of the most dangerous things any investor could ever do. That is 100% correct. Ignoring emotions, but emotions are just information. And the more, the stronger a human being, the better they can process emotions in the form of information and respond to them rationally. And the way I'm telling you this story is respond to them rationally in the context of a framework. And now, the first emotion you have is dollar denominated value loss. But I talk to you guys all the time about the business. Who the hell, if a pizza shop is worth $1 million and turns to 500,000 or 400,000 or $200,000, who the hell is going to sell a business that's making $1,000 a day? That doesn't make any sense. $1,000 a day is revenue. It's income. That pays bills. That's how you accumulate value for the future. It doesn't make any sense whatsoever from a business perspective. So that's why I find that perspective quite interesting and meaningful. So clearly, from an asset perspective, it's quite much more liquid than a business. It's much harder to sell a business. But who in business owns their businesses is staring at the property value all day long, or the estimated valuation of their business all day long, with property value being only a component of it, where the balance sheet and the revenue and that contributes significantly to the valuation of the business. But who's staring at the valuation of their business all day long? Now make decisions and choices based on the amount of cash flow the business has. Now, if the cash flow of the business doesn't cover expenses and the business is failing or potentially insolvent. But if you have no debt, you own your business outright, and all it is a cash flow generating machine, that's crazy. That's hard to do in the real business world. But in the dividend investment space, which I prefer the crypto space for dividends rather than securities markets, the cash flow has no debt. I have no bills, no expenses, no employees, no human resources, and it just generates cash flow. So as long as that cash flow is still there, that's the most important thing. When I tell you guys, I think of certain positions I have as purchases, which means I don't have them to liquidate. It's not something to be liquidated. And that blows people's minds. And that's the emotion, I guess. Ignoring that emotion is wrong because clearly I see my principal valuation is depreciating, and that's not ignorable. But the number that matters to me is if I'm making $2,000, $3,000 a day, that's awesome. That's meaningful. That changes everything. If even if it goes down, what matters is my expectation is with a significant meaningful time horizon, a well thought out time horizon, I expect that revenue to stabilize and go up as businesses expand, as the market sentiment returns, and as the interventionists act, and it just is obvious what it's going to do. The whole system operates in cycles. It goes up, it goes down, it's unstable, it's deflationary, there's intervention, then it stabilizes for a little bit of time. Is the system going to end and the only play bonds and forex long positions? It's strange. Um, all I know is my daughter's daycare is up 50% year over year. And I don't see that specific inflation. I tell you guys all the time, inflation is relative. Now, the macro folks will talk about, the macro market is net deflationary, which I 100% agree with. But a bar of deodorant costs more money, and my daughter's tuition is more money, and college tuition is more money. And as the Chapwood Index historically measured, the cost of consumables tends to be more money. Now, we all know the cost of technology tends to be deflationary. TVs cost less and less year over year, and that's true. But consumables tend to cost more money. And this goes into who said it in the stream? The food shortages. Yeah, food may also be a good investment, Mark said. So yeah, I do get worried about consumables, water and food. Um, those tend to go up in value. Those tend to inflate in price, and that's something to consider. And that's what I think of with regard to inflation, because that's your expenses. That's your and my expenses that we need to accommodate, which means we need to work, we need to generate revenue, we need to save, we need to accumulate fiat, accumulate inflation protected positions, accumulate inflation hedge positions. And that's what we've done. So on days like this, with the market looking like shit, I'm more comfortable than ever. The title of the stream is to respect the expression of the way you see the macro market. And that's not easy, but that's the comfort that I've found. I don't have to watch the charts. I don't sit here watching them anymore. I like to have them up because that tells me where we are with the market. I like the way Bitcoin looks. This looks cool. It's above the guppies. It starts to break down. All right, so be it. Check back in a year. That's when I rest comfortably with the revenue stream. As long as it's pulling in, what it's pulling in right now for me, that's awesome. And now if it's depreciates significantly, uh, the story still hasn't changed unless we have some significant regulation that changes my 5 year time horizon outlook for the potential of the revenue stream to still be there. That would warrant action for liquidation or position reallocation. But unless the story changes, I rest comfortably in my convictions. Let me hit you guys with a couple of comments. What do we got? Good morning. I've been on vacation for several weeks. What did I miss? Yeah, pretty much the depreciative environment. Um, Regulation coming down the pipe. Obviously, miners reallocating. It's going to take like a year or two for miners to reallocate to where are they going to Canada, U.S., Russia. They're leaving China, so it's going to take time for that to play out. So check back in 2023. The whole system is so large; it takes time for things to play out, and it doesn't worry me that much until it does, and then you take action. But you take decisive action only when a narrative changes, only when a significant part or significant component of the story changes, and nothing's really changing. It's still the same story, still the same story. Macro market deflationary, interventionists kick in. So let's see, why? How could the interventionists not kick in? They have to with the debt to GDP the way it is. They can't let the system collapse. They'll never be able to pay the what is it called, the entitlements that are due to for citizens, particularly the retirement population. How can they let pension funds collapse? So they're just going to keep the Ponzi going, or the system collapses. And if the system collapses, you should have physical gold, and you'll take out a chisel and you'll chip off pieces of gold, and you'll. If the system collapses, that's where better hope you have shotguns and hunting gear. So I don't know. You can't get too negative. You can't, but you got to be prepared. And I always tell my wife, I'm a worst case scenario kind of guy, meaning as long as I have the worst case scenario covered, I'm comfortable. So I'm tempted to get like $20 gold coins, like 50th of an ounce or a hundredth of an ounce, stuff like that. But then again, who the hell is going to do that valuation on the fly? So pure gold usually is most meaningful, but maybe small pure gold pieces. I don't know. Now I'm going off the system collapse deep end right there. I don't think we need to go that far, and I usually don't. Um, what are your thoughts on Ethereum US dollar stable LPs? It's the same thing as I've said historically. Ethereum USD stables are or LPs are dollar protected Ethereum long positions. It's dollar stabilized. When Ethereum appreciates, you're going to get less appreciation because of the dollar stable denomination. It's about like a Uni V2 balanced pool position rather than the Uni V3 with targeted bands. Um, but on the downside, you get deflation protection. If Ethereum decreases in price, you're going to lose less value because it's paired with a stablecoin. So LP positions with a dollar-denominated pair are are like are dollar stabilized. They appreciate less and depreciate less. Paid in FXS the same as being paid in ICE or Spell. Yeah, it's comparable. So there's overtones of these platforms that they're creating. I got a kick out of um, Frax. I think it's caught my attention. Joe, I put DApp on my LinkedIn and have investment portfolio managers looking at my profile. This amounts to circumstantial evidence that investment firms are interested in the centralized banking. I mean, there's yield here, and whether that yield is where that yield comes from. Do you think they care in legacy finance? Now, I care because I understand how it works. I understand how monetary policies work and how these systems create value and sometimes create value out of nothing, which is nothing out of the ordinary considering that's where fiat gets its value from, nothing. So it's the same thing. And okay, so I get a kick out of that. That's nice that it's catching their eye, and maybe I should adjust my portfolio accordingly or my resume accordingly. Ali, what's up? What's up, Encoder? Hello, my man. What do you think about Uniland on Polygon? I am not aware of it. It's not on my radar. Dark Mark. Hello, no. I haven't been able to watch for a while, but curious here. Olympus Ohm. Not on my radar, but I've heard of it. And what do they hold? A lot of fracks. That's why I've heard of it. Now, fracks is a very very interesting programmatic stablecoin, and I think that's the potentially very meaningful over the coming years, depending on regulation. And today's a big day with regard to the meeting that they're talking about with regard to stables and how they proceed with CBDCs. But we're talking about a multi-year time horizon to fully understand and fully experience from a hindsight perspective what the governments end up doing with regard to CBDCs and how they process regulation for cryptos as a whole and stablecoins that are not in their control, public stablecoins. So all this is going to take a lot of time to play out. So what we have is volatility. And I don't care 50, 60, 70, 80%. This is, frankly, all this capital was generated during the bullishness of the market anyway. I'll watch it go down, I'll watch it go up, and I'm respecting my expression of the market that these are where I want this is where I want, these positions are where I want my value allocated to for a variety of reasons that I discuss. There's honor in these markets, there's revenue and cash flow. And that's meaningful to me because that doesn't exist in legacy finance. Am I going to buy the gold miners are getting hammered also? There's not an inflationary environment. What are you going to buy? Are you going to fill your portfolio with treasuries and bonds and long dollar forex positions or just dollars in a bank account? Folks will say, "What's the matter with dollars in a bank account?" My daughter's tuition going up 50% is the problem with dollars in a bank account. Dollars in a bank account do jack shit. And dollars in a bank account get sold for treasuries the second they hit the bank account anyway. So why wouldn't I do what a bank does anyway? Why do I need the bank? I should just buy the treasuries. The bank's selling my dollars anyway for treasuries. I'm just going to do what the bank does. That's just the weirdest thing, right? I'm just going to skip over the bank and do what they do. Urea, looking into Val Canby gold bars, bro. They are made like chocolate bar. You can break pieces off. Interesting. Interesting. So I have my positions. I have some nice pieces of gold. Some of them are in retirement accounts, custodied by brokerages. Other of them are physical gold in vaults and stuff. But these silver. You ever have like a 1 kilogram silver bar or 100 ounce silver bar? Those things are awesome. Finally, the first thing I'd probably go to for a weapon is probably one of those damn bars. Those things weigh a ton. Well, they weigh 1 kilogram, but they're beautiful. There's something that's special about bars. Bars of physical metal, pure metal, 99.99%. They're beautiful. So that's a nice place to allocate value. Now, clearly, that's the historic inflation hedge, and we're not in an inflation environment right now. I mean, yields are pretty much down. Let's look at the 10-year. U.S. 10-year. Ooh, and not pretty. Look at that 200 EMA on the weekly. That's actually quite interesting. I wonder if Steven saw that. Or Colorado Travis. 'Cause that smacked right into it. But you look at that. Yeah, but look at this highlight right here. This is March of 2020. So what happens is when you have a deflationary event, bonds skyrocket in price. What was this, a 3 week period? 1, 2, 3 weeks. 80% increase in 10-year bond prices. So they become the risk on trade. And clearly, look at this wick at the bottom. So, and then they were able to stabilize the market. They probably started, intervening into the bond market. They, of course, that's what they did. And they stabilized the markets. But big bonds become the risk on trade. So you have to opportunistically sell them at the right time in order to capitalize on the significant price appreciation. So, personally, I don't expect prolonged bearishness. Um, I expect potentially a liquidity event, which is talked about very nicely by Stephen and Meter. And if we have a liquidity event, that's when bonds become risk on, and you sell them opportunistically, and then you're back into an appreciating market. We'll only know in hindsight what the market does. Does anyone really expect a prolonged bearish cycle? You adjust accordingly if there is a prolonged bearish cycle. You only know in hindsight how well you did allocating value in your portfolio, and all you can do over time is adjust your portfolio to best express the way you view the markets. If you view the markets as going to be prolonged bearish for a long period of time, you adjust accordingly. But in the end, you still need a revenue stream, right? Isn't that the whole point of applying value? You want to get revenue on a constant basis. Don't you want to pay a bill at the end of the month with the assets that you own? That's the whole point. Is to pay real world bills, to get revenue. So I think a lot of folks miss that. They're buying these assets saying they'll sell them in the future for more money. What are you going to do with that money? Put it in a bank account and watch it melt at 20% a year? So you need a more robust uh, ideology or way you view the markets needs to be more robust. It's got to be more meat to it. This is not just buy something and watch Bitcoin go to $1 million of Bitcoin and sell it for what, a dollar that's worth 1,000 times less in value, and a car is $100,000 for a base model. Doesn't make any sense. Revenue streams. So business, Bitcoin, you collateralize it, you never sell it, and you put the capital to work doing things. A lot of opportunity cost, in my opinion, with regard to the macro assets. This is why you guys know the vast majority of my position is allocated to like curve convex, revenue streams, rent VMs. Bancor is lucrative. Their monetary policy is extraordinary. Should make sovereign central banks jealous. What else do I have? I'll tell you what I have on a day like this. It's a good refresher, and I'll end the stream on it. Curve Rent, CVX, Cosmos, a little bit of Bitcoin. VEFXS is a nice size position. A little bit larger than my Bancor position. Polkadot still hanging on there. That's about it. Small positions, synthetics, Aave, a little bit of band protocol still hanging around. Gotta have more than one Oracle. Uh, wow, Syscoin still is appreciated. Old school Syscoin, Blocknet, Iris, Firo, StakeNet, little Kava. You know, big big thoughts on a decent time horizon for the Cosmos hubs. The captain knows about the Cosmos hubs and the China narrative. All right, that's about it, guys. You know, I know it's hard to look at these markets and stomach depreciation, but if you really want to save your dollar denominated value, this is times where you sell and you liquidate for cash. But what are you going to do with your cash? Your cash is melting anyway. So it's not as simple as that. And that's the problem. The problem is it's much more complicated. And I still argue the worst position to have is just cash in a bank account. It just melts. So that's why I would say it's better to own T-bills instead of cash. Shit, that banks think the same way. They literally think the same way. All right, last couple of comments, I'll wrap it up. The problem with gold is they do draw attention. You have gold, people will know. You may have some more. So, in a worst case scenario, you should rather have other items. Well, complicated, like toilet paper. Yes, toilet paper has great utility. That's right, my friend. Diesel VeChain generates income in another token. Most tokens distributed. Well, digest whether it's inflation derived or whether it's a transaction fee revenue stream or where does the yield come from uh, is what's most pertinent. Good morning. No question. Ideally, should people LP on Uni when volatile assets? So I'm not a fan of LP positions. What I really want is transaction fees of all LP positions, which is what curve positions facilitate, especially their derivatives. But if you want a long, like Ethereum position or a long volatile asset position, at least in markets like this, denominate against a stable coin, which will provide dollar denominated protection or dollar stability. It's meaningful. Like ETH USDC is an example of a dollar stabilized long Ethereum position. I'm betting on utility. That's exactly what I have. My entire portfolio is exposed to utility. And these utilities generate revenue streams. Um, and that is my bet as well. Thoughts on the sushi VC drama? Yeah, VC is really annoying. I follow, I like Good Girl Gone Crypto. She hits them hard. Um, a lot of copying and duplication, but this is where network effect comes in, and not getting drawn into the emotional aspect of should I buy the VC play or should I buy the original OG. Now, network effect is what where I'll rest my conclusions. I think network effect is better than a patent. Is entrenchment, carries momentum, and is one of the most significant properties of any project or protocol that you look at. Network effect is fundamental in human nature and will help guide you in processing opportunity cost analysis and finding the best places to allocate value. Network effect. While curve is not considered undervalued versus Y is well, its price is getting hammered. I keep the charts up. It's unfortunate, but oop, I don't have them loaded. Oop, I'll load them up real quick, and I'm going to wrap up the stream, guys. Oh no, those are OpenSea. Are they OpenSea? Where's my charts? There they are. No, no. Here's my charts. I do have them open. Yeah, both Bitcoin and Ethereum denominated curve has broken down of its most recent triangular formation, which is clearly a bearish position. Now we'll see. You know, these things obviously, what is a fake out breakout pattern, which is a very common pattern, and it does look like it's pretty much stabilizing, and that's a nice wick right there. If that starts popping up, that's very much consistent with a fake out breakout pattern. You only know in hindsight when you have if things play out favorably. I mean, who the hell held Amazon in 2000 with a 95% drawdown? At least one person did. So that is a very good historic analogy for how to really process a time horizon. Time horizon's a big deal, boys and girls. Let's wrap it up. 12:09 p.m. on a Monday, July 19th. I'm going to be off for the rest of the week. The odds are I'm not going to have streams Tuesday, Wednesday, Thursday, Friday. I'm going to try my best. I'll see what I can do. I'm taking some time off, and just I'll probably be on Discord. There's no reason I won't be on Discord. So, you know, you guys ping me. I'll be there, and I'll help you guys through these tough times. Just so much emotions right about now watching dollar denominated depreciation. I'll show you guys real quick. Where's my boop? No. Boop. Yeah. No, listen. I'm with you guys. I watch dollar denominated depreciation, but if I could come back to my account every couple of days and see five, six, $7,000 on convex, I'm not really complaining. And if it's $600, you have a tenth the size of the position, or if it's $60, it's just proportional, and that's very important to understand that you're getting a revenue stream. You're getting money that you historically didn't have. And it's assets that are working for you instead of you working for assets. So, all right. Well, oh, goodness. I've seen this up at 1.4. It's a 50% drawdown thus far. All right. But the revenue stream is still there 62% on your money. That's nothing to sneeze at. And that's something to be proud of. And that's something that's honorable as compared to the positions we have in legacy finance. So keep everything into perspective. Don't let emotions guide you, but don't ignore your emotions. You still need liquidity, you still need capital to pay bills. So you shouldn't have all your eggs in one basket. Never go all in, never spread too thin. Be deflation protective, inflation protective, and retain liquidity so you can pay your bills. That's all that matters. I wish you all a wonderful week. I'll catch you on Discord. Tell everyone to subscribe. I'll see you soon. Peace.